we have Mr. Rukun Tarachandani join us. So thank you so much, Rukun, for taking the time to be with us. Rukun is is a fund manager, of the Parag Parikh Flexicap Fund. He's, been in this industry for over 9 years. He started his career in 2013 as an equity research analyst, and that continues to be his strength. He's worked with companies like Goldman Sachs, Kotak, and before joining Parag Parikh. So he's a very avid reader, and he likes to read a lot about value investing and quantitative investing, behavioral finance. So this is, you would see a lot of this percolate into their research style. So he's an MBA finance from Management Development Institute, Gurgaon. He's also a BTech IT from Nirma University. So he has a very solid, tech background. He's also a CFA charter holder, as well as CQF, that's Certificate in Quantitative Finance. So having said that, Rukun, welcome once again. Thank you for being part of our call today.
Thank you, Sanjay. Thank you very much for having me. Good evening to all the participants.
Yeah. So Rukun, I'd like to, introduce Parag Parikh, which is quite honestly become a household name in mutual funds today. But I think your journey has been, one of the rare journeys we've seen in terms of a mutual fund company. So your flagship fund, Flexicap Fund, has about a 9-year track record now. It started in 2013, but prior to launching the Parag Parikh Flexicap Fund in 2013, I think your history with fund management and portfolio management goes back more than maybe 20-30 years. So we'd like to hear a little bit from you about that. But I'd also like to point out to the audience that the path that Parag Parikh has taken is has been very different in terms of a mutual fund that started from scratch. The typical route that mutual funds take is obviously to incentivize distributors like us with higher commissions during where SEBI and AMFI love that. But they've taken the longer route to success, so as to speak. Everybody who's invested in Parag Parikh has only invested because of their thought process, because of their investment philosophy, and because of the track record that they have shown. So if you see the last, I think, 2-3 years, the AUM has ramped up and more than double and triple. So we're so happy to have you. So we'd like to know from you firsthand, Rukun, what is this thought process of Parag Parikh? Why is it so different from other mutual funds? What is the investment philosophy behind this whole thing? Can you take us, through that?
Sure. So I'll just share a presentation which has, the history of the firm and the investment philosophy, and we can take it from there. Yeah. Parag Parikh, as the firm was founded by Shri Parag Parikh, and he was a multifaceted personality, wherein he started off as a stockbroker, but while he started off as a stockbroker, his heart was really into investing and into long-term investing. And while behavioral finance as a topic is something that is very popular today, people talk about behavioral biases and so on, and there is a general awareness about that. But he was talking about behavioral finance and value investing way back in to the early and mid 2000s, and he also did quite a bit in terms of authoring books to educate investors on these subjects. So his book Value Investing and Behavioral Finance is from an Indian, it tackles the behavioral finance and the value investing part from an Indian perspective. So at his heart, he was a long-term investor. And, that is where we get the core philosophy of the firm, or the core belief that holds everything that we do together. And that is the law of the firm, law of the farm. Essentially, what it says is that there is no alternative to long-term thinking and patience, right? So if you have a farm, you're going to sow a seed. Now, you cannot expect that if you'll sow a seed today, tomorrow you're going to get a fruit or a flower out of it. You need to, that seed needs to go through its period, its seasons, after which it will give you the right fruits or the flowers. So you have to be patient and long-term in your thinking to be ultimately able to enjoy the fruits of long-term investing. Again, if you look at the history of the firm, as you said, it has a very rich legacy going back to, it was started in 1979. Initially, this was a stockbroking firm. In 1996, we were one of the first to get a PMS license. And so our CIO, Mr. Rajiv Thakkar, he started managing the PMS from 2002 or 2003 onwards. So he navigated the PMS through the 2003 to 2007 bull market. Around the later stages of the bull market, he started to feel cautious. He did not have as much comfort on the reality and infrastructure stocks, which were flavor of the day, which were trading at very expensive valuations. So to a great extent, the PMS avoided the wealth destruction that happened in the realty and infrastructure stocks in the subsequent fall. So overall, he navigated the PMS well, and it created a good amount of wealth for the PMS investors. In 2012, we got the AMC license, and in 2013, we launched the flagship scheme, which is Parag Parikh Flexicap Fund. And from there onwards, so that scheme has about a 9-year track record now. And one of the things you'll notice is that, it's been 10 years approximately, just about from the time we got the AMC license. But we have only 4 funds, right? So it's not like a supermarket of funds wherein you have 20, 30 schemes, right? And I'll come to the thought process behind that in a while. So these are the 4 schemes, the Flexicap Fund and the Tax Saver Fund, which are our equity schemes. Recently, we had the Conservative Hybrid Fund, which is a debt hybrid product, and then there is a liquid fund. So coming to, why we have so few schemes. So we take the fiduciary responsibility that we have very seriously. So we do not believe in having flavor of the month schemes or, very specific sector focus or thematic focus kind of schemes, which might be flavor of a quarter or a year, and then, it just goes out of favor. We want the investors as a cohort to have the same kind of experience, right? So it's not that one small group of investors or one group of investors has a very different experience than in other group of investors. So, finally, we believe in having very open channels of communication. So in our fact sheets or through our investor letters, the CIO is very open in communicating about the firm philosophy. We annually have an AGM, which gives the investors an option to ask questions across a myriad domains, right? From stocks to sectors. To give a perspective, the last AGM lasted for something like 4 hours. So, that's I think one of a kind in India, where the investors of a fund have that opportunity to ask questions straight away to the fund manager. So moving on, I'll talk about the Flexicap Fund. So the Flexicap Fund, essentially, what differentiates us is 3 things. One is our investment philosophy, which is value investing. I'll have more to talk on it, but essentially what we are saying is we like companies which have low debt, high cash flows, which are minority shareholder friendly, and which are available at good or reasonable valuations. The other thing that differentiates us is having a Swiss Army knife approach. So if you've seen, in this graphic, a Swiss Army knife is essentially has everything. It has multiple tools in a single tool. So we wanted the scheme to have this kind of a flexibility wherein we can, in this scheme, we invest in Indian stocks, we invest in global stocks, we invest across market capitalization. So if we like, we are bottom up in our approach. So if we like a small cap fund, we are open to investing in a small cap stock, we are open to investing in a small cap stock. If we like a stock which is large cap, so we are open to investing in a large cap. Similarly, it's we invest across sectors. So we do not benchmark our sector holdings or sector allocations, or we do not look at it in terms of what the benchmark holds. If we like a particular sector, we will take positions in it. At the same time, if we are not finding opportunities within a given sector, so we will happily stay out of that sector. So we will not invest in a sector just because the benchmark has a certain weightage in that sector. We will invest only if we find merit in that individual stock. The third is that as a combining the global equity allocation with the domestic equity allocation gives you a tax advantage. So if you have a fund, or if you have an investment in a fund which is investing only into global stocks, then you don't have the Indian equity taxation benefit. By combining global stocks and domestic stocks in the same fund with this allocation, wherein we have to have at least 65% in Indian stocks, this gives us the benefit of having the taxation that is applicable to Indian equity oriented mutual funds. So coming to our investment style. So as I was saying, there are 5 key tenets to our investing process. First, we want to partner with managements that are friendly towards minority shareholders, or that treat minority shareholders fairly. So, we realize that at the end of the day, we are, we are partnering or we are investing in a company wherein there is a controlling shareholder. The controlling shareholder can decide, where to allocate capital, where to give out, how much or dividends or buybacks to make, so on, right? So controlling shareholder a lot of time has a lot of power. And to that extent, we want to only partner with promoters or controlling shareholders who are fair to minority shareholders. So who treat minority shareholders at par with how they treat their own investments. Next, we look at investments not just as pieces of paper or as trading instruments. We genuinely are interested or are investing in the business of the companies. What this ultimately means is that we are trying to take a view on the business of the company 3 years or 5 years down the line. So we are not looking to, we are not focusing on things like what will be the quarterly earnings in the next quarter, or, will the company be able to beat analyst estimates next quarter, that kind of short-term stuff. What we are looking to understand is, how much can the company grow from here over the next 5 years? Can the company grow with decent profitability? Does it need capital to grow? So those are the kind of long-term questions that we are interested in when we are analyzing a company. Third, we believe, in buying companies that are cash generating and have low debt. So over the last about 1.5 to 2 years, you've seen a lot of companies get listed into the markets which were burning cash, or there are companies in the market which have very high debt. So we want to invest in companies wherein cash flows are strong. Again, a lot of times, in a lot of cases, we find that the company might have good reported P&L profit, but the cash flow might not be strong. So we are not just happy with P&L profitability, we want cash flow based profitability. At the end of the day, it is cash flows that you can reinvest or you can distribute to shareholders. again, low debt is something that we've been focused on for quite some time, but this becomes important in the current scenario, which I'll come to later on. Um, Fourth, we are looking to partner with businesses which have a competitive advantage. So if you look at the portfolio, you will typically find companies which are duopolies. In some cases, they are monopolies in their own businesses. And essentially, these companies have a strong competitive advantage, which makes it difficult for somebody else to come in. To give you an example, we have an investment in Microsoft. Now, everybody of us uses Microsoft products, right? Windows, Office, so on. And we know how difficult it is to switch from these products. So, it is very difficult if you want to take Windows out or, get or start working on some other operating system like a Linux or something else. Same is true for Office. Similarly, when you look at a company like Google, practically almost all of us, 99% of the time, we are using Google as a search engine. It is very difficult for some other search engine to come in and displace Google in that business. So we are trying to find companies wherein a competitor would have a very difficult time to break into their businesses. Fifth, and a very important point for us is we want to avoid overpaying. So, just because a company is good, just because it is generating cash, just because the promoters are treating the minority shareholders fair, that's not enough for us. We also want to buy these companies when they are trading at valuations that based on our assumptions and calculations are attractive or are reasonable. So we will not buy a company just because it's a good company. We also want it for fair valuations. So what does all this translate into? Essentially, what we are saying is we are trying to aim for moderate returns, but without taking excessive risk. So, we want to pay a reasonable price for the business that we own. This means that I will not pay an insane valuation for a company that I like, which in a market like today or in any weak market can correct because of valuation correction. So if I follow these tenets, I believe that I can have a downside protection and some capital preservation. And if I can do this consistently, that will help me compound wealth. So moderate returns without excessive risk. We are not trying to hit the ball out of the park. We are not trying to identify, or take risks in search of multi-baggers. So long as we have reasonable return without taking excessive risk, we are happy with that. Coming to our global allocations or global fund, predominantly today it is largely US allocations. So why do we invest in global companies? And there are, a couple of main advantages to this. First, as I alluded to earlier, having global investments in the same fund as Indian investments gives you a tax advantage. So you don't have to pay, or you can pay the Indian equity scheme taxation, even though you have global taxes, provided your global allocation is less than 35% of the overall fund. Second, if you look at the history of capital markets, we've seen that, the best performing markets keep changing. So from 2000 to 2007 or 2010, emerging markets, including India, did very well. We did better than what US market did. But from 2010 to 2022, since then, US markets have done better than emerging markets, including India. So the winner keeps on changing every 5 years. We don't know what in the next 5 or 7 years, which market will do well. Having allocation to both the markets helps us diversify the risk. there is also a fundamental benefit of having global allocation, which is that you don't have business specific country risks. So, uh, again, the economy can go through periods of or bad patches, right? So from 2012 to 2014, Indian economy went through a major slowdown. Uh, Having global allocations helped over that period of time. So uh, it is not necessary that, if India is not doing well, other countries are also not doing well. There might be situations wherein India as an economy is not doing well, but US or some other country, some developed countries doing well. So it might help to diversify. It reduces the portfolio volatility. It gives us a wider choice to make our investments in. So to give a perspective, our investment universe is today close to around 700 stocks. 400, 450 stocks are Indian stocks, and the rest are global stocks. And our analysts track the same analyst, which is allocated to a sector, tracks both Indian stocks and global stocks. So an auto analyst tracks Indian auto companies, and he also tracks global auto companies. And this helps in two ways. One, the analyst has a very good grasp of what is happening in the sector globally. In today's environment, wherein most of the changes or most of the themes that are happening are global in nature, having that global understanding is a big advantage. So the auto analyst, even before a lot of companies in India started talking about EVs, had a good knowledge of the EV industry because he already knew what Tesla had done in the US. Similarly, the tech analyst, he's looking at Indian IT companies, but he also has an understanding of what is happening with companies like Accenture, what is the tech spending in US, Europe, and so on. And that helps him, get a better understanding of Indian companies as well. Finally, this means that if there are not good opportunities in India, the analyst still has option to go and recommend something which is in the global market. So if, let's say consumer sector, which is expensive in India, if the analyst is not finding opportunities in the consumer sector, he can evaluate global companies and come out with opportunities because of that wider choice. And finally, valuations, wherein in some cases, global companies can be materially cheaper than their Indian counterparts. So, for example, 3M as a company in India trades at very high valuations, but 3M globally trades at much cheaper valuation. So you might have an opportunity to gain India exposure through the global parent. Just a note here. So SEBI came up with a circular which in February, which has meant that mutual funds have had to stop their investments in foreign securities. And so in case of PPFAS, our incremental investment in foreign securities have been stopped from 2nd Feb. And what this means is whatever allocation we had till 1st of Feb, that remains. But incrementally, we are not able to invest additional money in global companies. As of now, we don't have a clarity on when, the limit increase will happen, and when we will be able to restart investing in global companies. So as of now, incremental investments are not happening in foreign securities.
Thanks, Rukun. I think that was, quite a, elaborate, presentation. I think it really gave us, very good sense in terms of, the thought process and the investment philosophy. We do have, a few specific questions in terms of the, in terms of your fund. Before that, we have a lot of our customers who actually want to get a sense of really what's happening in the broader market. If you don't mind, if you can just spend about 3-4 minutes on that. So if you see, as we went into the first lockdown in COVID, the market crashed or pulled back a lot. Then from there on, you saw the market climb higher. On the Nifty, we reached about 18,600 and we have retraced back almost about, we've lost about 16-17% from the heights. So, the sense is that, okay, where do we go from here? How is the next 3 to 6 months looking from a macro perspective, taking into factor the war that is really unresolved as of now? There's been interest rate hikes by the central banks, almost around the world. Inflation is at its highs in many countries, especially in the US. So, how does an investor make sense of all this? And what is the market volatility going to be like over the next 3 to 6 months? Any thoughts on that?
So, our view on the markets is that, the era of easy money or free money for companies is coming to an end. So, as you highlighted, interest rates are going up. The increase in interest rates is on account of the inflation being high. I'll come to inflation in a bit, but interest rates are essentially normalizing. So, the interest rates today are not unusual if you look at the longer term history of Indian or US interest rates. What was unusual was the kind of extremely low interest rates we had over the past 2-3 years. And what that meant was that a lot of companies which were burning cash, a lot of companies which had a lot of debt, they could still get capital at very low interest rates, and they could still go on with business as usual, even though the core business was not generating enough profitability. So that kind of an easy money or free money era is coming to an end. What that means is that companies which burn cash, companies which have high leverage, which have low profitability or weak cash flows, these kind of companies will find a tough time. From our perspective, as I highlighted, we've been focused on owning companies with low debt and high cash flows ever since. So from our perspective, the core philosophy or the core strategy doesn't change much. In terms of, we might see some changes in terms of, improved profitability for some sectors, like, as interest rates rise, private banks which have high amount of CASA, they will benefit because, their cost of funding will not increase as much as some of the other NBFCs. So private sector banks might benefit fundamentally from the rise in interest rates. I think, from our perspective, the strategy remains the same that I discussed.
Sure. Thanks for that insight.
Sorry, I was just coming to, I highlighted that I'll come back to inflation.
Inflation, yes.
So, inflation is high, and if you look at it, the reasons are partly structural and partly transitory. So, in terms of structural reasons, there has been some underinvestment in commodity supply chains over the past 5 or 10 years, and which is now leading to some amount of higher inflation. But there are also some transitory factors like the war going on in Ukraine, and the fact that the monetary policy was extremely loose in the past 2-3 years. So we think that over the next 12 months, some of these transitory factors might ease off. So inflation from the current elevated levels might ease off in the next 12 months odd. But to what extent it will ease off, we'll have to see. We'll have to see how the war plays out. We'll have to see how commodity supply chains play out and so on.
In terms of your fund itself, you did share a lot of insights about your fund. So you normally run a strategy which has anywhere between 25, 26 stocks. I think at the moment is what you have. So if you take typically mutual funds, especially in the flexi cap, large and mid cap segment, they run, portfolios which have 50, 60, 70 stocks. But your portfolio is, I don't want to use the word concentrated, but it's very focused. You have a specific, set of stocks, 20, 25, 26. Is that by design? And what's the thought process behind that?
Yeah, so it is definitely by design. As I said, we are bottom-up investors, as in we make an investment in the stock only when we believe that it makes sense to be owning that stock in individuality, right? So we don't go in with the top-down process that, if a stock X has a 9% or 10% weightage in the index, then I should also own that stock. If I don't like it, I will own less. If I like it, I will own more than the index. That is not what the thought process is. I will buy into a company only when it makes individual sense. And when you think about it from that perspective, adding new investments is also a function of looking at the investment, looking at what we sell and where. So, for example, if today I have 30 stocks and I have to add a 31st stock to the portfolio, my consideration is not just, whether the 31st stock makes sense. It is also that, does it make more sense than the 30 that I already have? Not just from a return perspective, but also from a risk perspective. So if I have allocations, already decent allocations in the banking sector, do I want to add a fourth bank, which I like, but which I don't like as much as the top three banks that I have? So considering that, it is by design a concentrated portfolio. However, I'll just add that concentrated, people look at concentrated in terms of number of holdings, but it is not about the number of holdings, it is about your return streams, right? As in, what I mean is that I might have 30 stocks, but they are very diverse in terms of their businesses. So there is the entire offshore piece. Again, a lot of the global stocks people club as tech, right? So Facebook, Microsoft, Amazon, everything people say is tech, but it is not a single sector or even the same business. So Google and Facebook derive majority of their revenues from digital advertising, which is very different business than what Microsoft is. Microsoft is largely cloud and the Office and the Windows ecosystem. So when you look at the diversity of income streams, there is a fairly wide breadth of diversity that is there within the fund. And again, when you look at the longer term history of the fund, you can see that the concentration doesn't necessarily mean or hasn't meant that. Again, when I say concentration, I mean the way you are referring to in terms of number of stocks. It hasn't meant that we have a higher volatility. In fact, our volatility would be lower versus the index or some of the peers.
Yes, that is one of our questions. But quickly, I think you made a very interesting point, Rukun, that it's not about adding the 31st stock, but it's about understanding whether it's going to give me something else compared to the 30 that I already hold in my portfolio. I think that makes a very valid point. I know you spoke a lot about the US stocks, but we've been having a lot of questions from our customers. Is that already you have about 20-25% of your portfolio currently, as you mentioned, in Facebook, Amazon, Microsoft, Alphabet. There is this thought process that India is the growing economy, India is the emerging markets. So Indian stocks are supposed to give you higher returns, not stocks that are trading in the developed countries. Yeah. So is that true, or no? There are few companies that can really add some value. Do you care to share a quick point on that?
So first of all, the fact that India has been a faster growing economy versus the US has also been true for the last decade. But if you look at the market returns, it doesn't necessarily mean that Indian markets have had in fact, US markets have had a better return. But even that aside, right, The fact is that a lot of the companies which are listed in US or some of the other markets, they're not US specific companies. So yes, an Apple is listed in the US, or let's say Google is listed in the US, but Google's digital advertising business is spread across the world. So in fact, if you want to benefit from the digital advertising growth, right? Google in India, let's say, or in emerging markets or anywhere outside, Google and Facebook are the best placed companies to benefit from it, right? So a lot of these companies derive a good amount of their revenues and profitabilities from outside US. A lot of their growth is actually coming from geographies outside US. So, just because a company is listed in US doesn't mean that, the revenue and profitability growth is restricted only to US. Or at least we are not trying to find very local US specific companies, which, in fact, that is something that we might not have an advantage to.
Okay.
So, I mean, if there is a small company listed in US, which is working only in US, right? We will not have as much of an insight into its business as we might into the business of a Google or a Facebook or a Microsoft.
So I think the takeaway for us is that even though the company may be listed in the US or any different country, the consumers are all around the world, and that's that's the reason to buy it.
Yeah, and it's not just true for US companies. I mean, if you look at something like Tata Motors, right? Bulk of the revenue is coming from JLR, wherein the revenue is spread largely in Europe and US.
Right. Yes, of course. So, I mean, I'd also like to share to the audience that, today Parag Parikh Flexicap Fund has become one of the, bigger equity funds in the market. Their AUM, assets under management, has crossed more than 22,000, crores. And I think probably there are only about, 14, 15 mutual funds in the industry who can, make that claim. Rukun, do you see this, is size as you go from 20,000 to 25,000, 30,000? Do you see that as a disadvantage or as an advantage, or it really doesn't matter?
So, first of all, when we, generally size is considered a disadvantage, but when you look at size, you need to consider where the edge of a particular fund is coming from, or what is the reason for that fund's outperformance historically. If the fund's outperformance historically is on account of churn or trading, right? So there might be a fund which is very good in churning the portfolio and taking advantage of short-term market movements and generating performance because of it. So if the fund is a high churn or a high turnover fund, then as the AUM grows, it might become difficult to maintain performance levels. However, if you look at our case right from inception, even when we were like a 500, 600 crore AUM fund, our portfolio turnover has always been very less. So our portfolio turnover has varied between 15% to something like 25% annually, right? So we are essentially buy and hold investors, or we are essentially investors wherein we like a company when it's attractively valued, and then we hold it on for 4 years, 5 years, in some cases even longer. So with that kind of a strategy, the size of AUM becomes a bit less of a factor. So that is one. The second thing is that it's good to have reached this scale, and people are talking about the size of the AUM. But the reality is, if you look at us in the larger scheme of things, right, we are still very small. And what I mean is that as a fund house, we just have 2 equity schemes, and cumulative, those 2 together are, let's say, 23,000 crores of AUM, right? Would it be any different if I had 10 schemes investing in the same set of stocks with each having a 2,500 crores of AUM. For me, the challenge of investing the money would be the exact same. So rather than comparing the AUM at scheme level, it might be good to look at it AUM at a fund house level, right? And on that perspective, we are still very small versus a lot of other big funds. Third and very important point is that a good amount of the fund is also invested in global stocks, wherein liquidity is totally not an issue. So, when you look at size, automatically right now 22% is in global stocks. So if you eliminate that 22%, the rest of the Indian piece is still low. Currently the AUM level and the flows that we are seeing, we are comfortable. We are not finding an issue in deploying the capital.
So I think excellent points you made there in terms of some of your, 20% is actually not in India, and as a fund house, you're still on the lower side, and I think you definitely have a lot of milestones in the future. So we will like to, go ahead. We have a lot of questions coming in, on the personal chats as well as on the chat box over here. So we'll go ahead and, ask a few of our customers questions. So if you would like to ask a question, please do mention it in the chat box, or if your video is on, you can raise your hand. So let's get, started with a few of our customer questions. Vaikunth sir, you posted a question on the chat box. Would you like me to read it out, or would you like to pose the question directly to Rukun?
Yeah, I would like to ask him.
Please go ahead, sir.
Okay. How come the FIIs went out of the market in such a tsunami way from India? And when are they going to come back? At what level of the Nifty the FIIs will come back?
So the reason you've seen an outflow is because it's first of all, it's not an India specific reason, as in it's not just India wherein FIIs are going out of. FIIs are taking money out of markets across the world and going back. And the reason is that, as I said, the cost of capital is increasing. Interest rates domestically for them in the US are increasing. US markets have corrected more than what Indian markets have corrected. So from their perspective, I think they're finding avenues to deploy that capital domestically, either in their equity markets or in the fixed income markets. Second, what also happens is that when you have a correction of the size that or scale that we've seen in the US markets, you also have, if somebody had a leveraged position in the US market, or some FII had a leveraged position in the US market, they have no choice but to also redeem their investments in the other markets that they might have, because they have to meet the margin calls that they have that they have domestically on their US holdings. So you have to see the FII outflow in light of the global FII money going out, not just from India, but other countries. And also the fact that as a market, yes, we've seen a correction, but we've not seen as big of a correction as some of the other markets have seen. So, that is other factor that you must take into account. As to when will they come back, it's anybody's guess. I don't have a precise answer to, when FIs will start investing again. I think from our perspective, we spend more time, looking at individual companies and thinking whether it makes sense to be investing. And at this point of time, you are starting to see companies at reasonable or attractive valuation. Doesn't mean the entire market is attractive or cheap. We have a wide dispersion wherein some sectors or some pockets are still very expensive. But there are also companies that have become fairly cheap, where they've become fairly attractive on valuations. So we are starting to find areas to deploy capital, incremental capital.
I think that's great news where a fund manager says there are few stocks, few sectors which are starting to look very attractive. I think we're definitely looking forward, to money to flow into these, sectors which have come into a good valuation right now. We have a very interesting question from Mr. Srinivasan. I think I'm going to piggyback on that question and add something else to that as well. Srini sir, if you're there, I'm going to go ahead with your question. So some of the recent additions in your portfolio have been, Power Grid and Coal India. This comes in a time where there are a lot of, portfolio managers that want to, chase after the quicker money, the tech money, the valuation-based sort of companies. And Coal India is your most recent addition, right? A very, very, traditional business. One may even argue to say that, okay, fossil fuel is going out in the next, 5 to 10 years. EVs are coming in, but you've taken a very strategic call on this. So how does a fund manager in today's context, where you have portfolio managers chasing after the next, the next big thing or the next quickest, money making avenue, you've gone into something like Power Grid and Coal India. What is the thought process behind that? Srini sir, if that's your question. Yeah, we can go ahead.
Just adding one more thing, Sanjit, to that.
Sure,
see, one of the philosophy that you have said is you invest in those companies where the minority shareholders' interest will be protected. And government companies are definitely not known for that per se. Keeping that also in mind, how does this come as strategic fit other than being a dividend yield?
So, so first of all, Sanjit, to what you mentioned, partly your question itself answers, is my answer in the sense that, since everybody is so gung-ho on some of the new tech investments or even some of the very good quality names, that they're trading at valuations wherein we are just not comfortable taking positions, right? So there are a lot of companies, let's say in the consumer sector, which we like, but the valuations are such that it doesn't make sense, from to be invested there from a longer term perspective. So it's not that we do not evaluate these companies. We have a very wide universe, and we do evaluate companies in the new tech space, companies in consumer space, and so on. But we've not found valuations there attractive. Coming to Power Grid and Coal India, first of all, see, as I mentioned, we are looking for companies that have some competitive advantage or some moat. And if you look at, Power Grid, first of all, what we are seeing is that, power transmission is increasingly becoming very important with the rise of renewables and so on, right? These can't be, renewables can't be, they're good for the environment. They're relatively cheaper, but they can't be stored. The electricity generation is very, it varies depending on the time of the day and so on. And consequently, power transmission is becoming increasingly important. Power Grid is a regulated, entity in that sector. Whatever capex they do, they are assured of a certain ROE in the transmission side. And considering the valuations that were there in broader valuations in the market, this was still available for a 15% return on equity. The stock was still available at less than 2 times price to book, a reasonably good dividend yield. And as I said, there is still a decent amount of capex to be done on the transmission side in India. So, from a business perspective and on the valuations perspective, it definitely fit into the portfolio. Coming to Coal India, again, it's largely a monopoly within the coal space. It does not enjoy a free pricing of coal on the entire portfolio. About 80% of the portfolio or the sales are under fuel supply agreements. but still, if you look at the ROEs of the company, they are fairly healthy. The balance sheet is extremely strong, and you have valuations that are extremely cheap, considering the dividend yield. So while the benefit of higher coal prices might be applicable only to, let's say, about 15-20% of the overall portfolio, even the residual business is decent. Now coming to the point of investing in PSUs. So, first of all, when we are looking at PSUs, we want to invest in PSUs only where we think that, it is a monopoly or there is not an alternative. So if you want to today invest in the transmission sector, there are extremely few companies that are there. One of which is the largest of which is a PSU. Similarly, from the coal space, there is only Coal India, which is there, which can, there are few companies, other companies which are very small. So if you want to get exposure to the coal mining space or to the coal space, Coal India is practically a monopoly. So in that context, and also you have to keep in mind the context that, still combined, the two companies are just about 10% of the overall exposure. So, we avoid investing in PSUs, but given the valuations, given the broader market valuations and the alternatives that were available, this made sense. And again, you have to look at the valuations, the overall allocation to these companies in the total portfolio. So it's not as if, we have a 30% or 40% allocation to PSUs. We have, between the two, there's about a 10% allocation.
Okay. Yeah, that definitely, I think for us, as a wealth manager, I think we see the connection between your value investing style, your philosophy, and, practicality actually getting married to each other. So thanks for that insight. So you have about 10%, you're sitting about on 10% cash at the moment, right? 8, 9, 10% at the moment. So on 22,000, that's about 2,000 odd crores. Is that, is there any specific reason for that? Are you waiting on the sidelines, or, is that by design, or is that just accumulation of cash?
No, so I would say don't, on a month-to-month basis, you shouldn't pay too much attention to the cash levels. It can vary a bit month to month because, we might have, in some of the names, we might have buy orders, or we might have limit buy orders that are pending. We just haven't had the price reach there, or, so on. So this can go up or down in a given month. It is not structural. It is not as if we've taken a view that we will have 10% cash or anything of that sort. You might see that come down a bit or go up a bit from month to month.
Great. Okay. So that's something we are not going to read into that much.
Yeah. Yeah.
We have another question from, Mr. B Money. Is this market correction, which are the stocks in your fund, if you may share, that it's gone below your, the purchase price, but you still have a lot of high conviction in it? Is there something like that you'd like to share?
So see, most of the stocks in the fund are actually have been held for quite some time, right? Because they've been, as I said, our turnover is very low. So most of the stocks are in the fund for, about 3 years, 4 years, and our purchase price would be much lower than what the market price is. So off the top of my head, I can't think of a name that is that might be lower than the purchase price. What I would say is that in terms of, which ones we've been adding, as I said, we have a positive view on the private banking space. So that is one area wherein we've been increasing our allocations. So HDFC, ICICI, these are the 3 names in the portfolio, wherein we've been increasing our allocations gradually. Yeah.
Sure. And you mentioned the low churn in your portfolio, right? So your turnover ratio or the churn ratio is, extremely low compared to, other funds. And, we're talking about somewhere between a 15 to 20% sort of a, turnover ratio. Is that really is that completely by design? Is that a very core area that, you want to have a low turnover ratio and that's integral to your philosophy? Is that so?
So, see, we don't go in with the thought process that I want a low turnover, that I've bought a stock and I will not just sell it, So that is not, but it is an outcome of the process. And the process is that we are very focused on long-term investing and long-term goals for the business. So I mean, to give you an example, we made an investment in Persistent and, the business was had its hiccups, but it was attractively valued. While it had its hiccups, it was also growing. Valuations were cheap, and it kept on becoming more and more cheap because the stock didn't go anywhere for about 3 or 3.5 years, something like that. But when something like that happens, we don't go in and say that, just because the stock has not given me a return for 3 years, I will simply sell it, right? What our focus is that over these 3 years, the business has done well. Valuations are still cheap. So I continue to hold it. And, as you had it, in the 5th year or the 4th year, the stock went up 10x from the purchase price. And, it made up for that entire 5-year duration of returns that we did not have in the earlier period. So we are extremely patient with the companies that we invest in. We don't really track what the price is doing, rather we are focused on what the business is doing.
I think Persistent has been, Persistent, the company itself has been a very classic example in your, in your fund. It's a case study by itself, and coincidence is, you really showed your persistence on that stock. So I think we don't have time for that, but I think, it would be really nice to discuss on that stock probably some other time. We wanted to finish at 5 o'clock, although we do have a lot of questions coming in. So we'll probably just extend it, for another, 12 to 15 minutes. We'll try to wind up by, 5:15. So very quick question over here by, Mr. Suresh, saying that there's been lots of discussion regarding, US going into recession. In case that happens, the US markets may fall further. Will it be good to wait until the market trend changes? I know you may not be able to answer that, right? So I'll not, force you to answer that question. But, the stocks about recession, markets may tank. Any thoughts on that?
So, on recession, see, honestly, we don't have a view on, whether we will go into a recession or not. And, the reality is that while everyone talks about recessions, if you look at the actual long-term track record of predictions around recession, it's been extremely poor, right? So there's a joke that economists predicted 20 out of the last 5 recessions. So, I don't really have a view on, how that will pan out. Having said that, we are very comfortable with the companies that we are owning in US. The businesses are still growing very well. So, Google at that size and scale is still growing at, between 15 to 20%. Microsoft at that size and scale is still growing at 15 to 20%. So a lot of all these companies are still growing very well. They are, in terms of valuations, if you look at it, the valuations are very reasonable. So balance sheets are reasonably strong, in fact, very strong. So we are very comfortable with the holdings that we have in the US. We can't add to them because of the restriction that has been there. But as far as our investments are there, we're very comfortable holding.
And one, I think Mr. Srini also raised this point earlier on, on the chat box. So there's a recent SEBI circular on, 17 June, which says, per AMC, there's a particular limit. Do you see yourself, increasing overseas allocation, or that will have to wait for some time?
So it is something that we are waiting for a concrete clarification on, but our view is that as per that directive, it was only meant for funds that have seen a redemption and have taken money or have repatriated the dollars back, and they can reinvest those dollars once again. In our case, we've been fortunate enough that we've not had any redemptions. We've, we have not taken any dollars back. So our interpretation and right now the thinking is we will not be able to invest in US as of now. I mean, in any overseas stock as of now. Yeah, that's our interpretation.
Okay, so we will await that clarity as and when it comes. We have a question from Ms. Lalita Lakshmi, one of our oldest clients with us. So she said basically inflation, is on the rise. Recession in the US, we spoke about that. COVID, Ukraine war, repo rates, on the rise. Market is so volatile. Stock market is volatile. Cryptos, just crashing down. Gold prices are, not so attractive. Real estate has not been doing so well. Where does the small time, Indian investor go to get returns? Not that most of our customers are not small time investors, but, where does a layman, small time investor go to get money, go to get returns in India?
So,
is the equity, story intact? You could share your thoughts.
Yeah, so see, from a longer term perspective, if you have a 5+ years kind of a time horizon, as I said, valuations have become reasonable. So, as they say in equity markets, you can either have a very good outlook and at the same time very high valuations, or you can have a bad economic outlook but reasonable valuations, right? So last year everything was gung-ho, but valuations were a bit very expensive. And today, yes, there are concerns on the macroeconomic front, but at the same time, valuations have become reasonable. And again, if you are investing from a perspective of 5 years or more, I think these things will even themselves out, right? So if you look at the past 5 years, we've had quite a bit of macroeconomic upheaval, right? So we had COVID, post GST, or in the 2018-19, you had the entire ILFS and Yes Bank issue, the NBFC crisis, and so on. So it's not that, we've not had macroeconomic uncertainty earlier. And it's not that we will not have again in the future. So if you have a 5+ years kind of a time horizon, I would say keep, maintaining your equity allocations, keep running your SIPs. And over the time horizon, I think it should be fine.
So moving from one of our, oldest customers to one of our newest customers, I would say this question is pertinent with a lot of, first-time mutual fund investors. I mean, they would have had some SIPs, for the last, maybe about 5-6 years. But today they're getting into mutual funds, they're getting into the equity markets in a very big way, right? So we have a question from one such investor who says that, okay, I can buy only. So this is a question from, Ms. Sangeeta, who says that, okay, there are, 5-6 mutual funds that I can buy. And if I want Parag Parikh Flexicap to be, one of those, core funds, then what is the one thing that really separates Parag Parikh Flexi from the pack?
So I would say, just look at our portfolio and compare it to any other Flexicap funds portfolio, right? I mean, I think you'll have your answer. So if you look at the portfolio, it's very different from what a lot of other funds or many other funds would have. One, as I said, it's a completely bottom-up portfolio, as in we don't go in with the thought process that, a stock X has a very high weightage in the index, so I'll also have stock X, or even with the thought process that large cap is 80% in BSE 500, so I will also have 80% large caps in my portfolio. So similarly, the global stock exposure, I'm not aware of any other Flexicap fund that has this. So if you look at the portfolio, in fact, of us, I would say it is difficult to find another fund that is similar to us rather than, finding other funds. So you'll just find that we are very different. And I think no matter what I say or what anyone says, you should look at the portfolio holdings and, see that for yourself.
Yes, definitely. I think, we can vouch for that as well. So yeah, Lalita ma'am, I was not talking about age. I was talking about, being with us for the longest time. So I think, on that note, Rukun, we've been flooded with a lot of questions, but I think you answered a lot of it in different ways. Right. Probably one last question is, is there a lot of clients have been asking on a sector, is there any sectors that you need to be looking at? Are you follow a bottom-up, stock selection process? Is there any sector call, or is there any sectors that you prefer? One or two, or not really?
So as I said, private banks is one space that we like, and I said we've been adding to that space as well. Outside of that, it is very stock specific. So going back to the outlook that I shared earlier, what we are seeing is that companies with weak profitability, weak cash flows, high debt are struggling, and that is true across sectors. So it's not as if, that is true in one sector and not in other sectors. So, in other sectors, it's very much bottom-up opportunities that we are trying to find. Utilities, again, is something wherein there are few companies, some we already own, we discussed Power Grid, that look interesting. Yeah.
Great. So on that note, I think I can easily say, because we interact with so many funds, so many fund managers, I think this fund definitely, stands apart in terms of its philosophy, in terms of its, style, and, for very good, for very good reasons, we've added it into our core, fund selection. And for, certain obvious reasons, there are many, national distributors who have not yet participated in this for, various reasons. But we really believe, this is a fund that fits into a lot of, a core philosophy that we believe in, something that our clients, subscribe to. And this is one of the funds where you can get a good overseas allocation, a sizable overseas allocation. At the same time, you don't need to pay the fancy, taxation, overseas taxation of 30%. So you get the benefits of both. And we are definitely, all the best, to you and your fund. We're definitely looking forward to seeing you guys grow, multifold over the years to come. And we definitely want all our customers to participate in that, very profitable journey. So having said that, Rukun, thanks once again for being part of this call. Thank you for spending your valuable time.
Thank you.
And on behalf of the entire, team at Wealthworks, we would like to, thank all our, clients for coming out, taking the time and staying with us. Almost all of you have stayed with us till the end of the session. So thank you, one and all.
Thank you very much. Thanks to all the participants for joining.